Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker who specialise in providing trading services in forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Good afternoon, Michael.
Very good afternoon to you, mate. Happy Thursday. We've almost made it to the end of another long week and plenty for us to discuss once again.
And we're actually recording on a Thursday, which is a good thing after last week's slightly technology-inspired delay, shall we say.
Indeed, it's a miracle. The internet in Pepperstone HQ has decided it wants to behave itself this week, so fingers crossed that holds out.
Yeah, unlike my PC, which decided to not behave itself just before we came on air and resulted in me doing complete reboot. Anyway, more records for the FTSE 100 this week. Welcome
Indeed.
News. We're not quite at 10K, but we didn't get far off at 99.30. And the news that the US government is looking to finally reopen.
Yeah, absolutely. I mean, we haven't done 10,000 on the FTSE this week, but it very much feels like a question of when rather than if. I think we need to get those FTSE 10K baseball caps printed pretty damn quickly at this point. And the market clearly cheering stateside, the reopening of the federal government. They are back up and running as of today, the record long shutdown coming to an end. And I think that's just allowed market participants to price out the risk that this was going to drag on and on with no end in sight, and also price out the downside growth risks that were stemming from that as well. So by and large, everyone is relatively optimistic, it seems.
Indeed. But before we get into the topics for the day, or the week, shall we say, let's get the risk warning out of the way to keep everyone's compliance departments reasonably happy. And I'll just turn my ring light down to take the shine off my forehead.
It's a problem we both suffer with these days, sadly.
Yeah. But I got over 30 years on you. So what's your excuse? Anyway, yeah, right, okay. And of course, I didn't have a stressful job, did I? Anyway, the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers, or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so we've got quite a bit to get through this week. Obviously, the primary driver, I think, of markets this week has been the fact that Trump has finally signed the papers to end the US government shutdown. More records for the FTSE 100 this week, as we talked about just prior to the risk warning. But I think there's still a tendency here to sort of think of this in the context of the economic damage that the shutdown has done, and the possibility that the Federal Reserve will probably cut rates again in December. So we'll go into that because obviously there's the Fed minutes next week, which we'll talk about. But on a macro level, there's not been particularly good news here in the UK either, as well as the US. So, sorry, there was a bit of a midge just flying in front of me there and I just squished it.
I wonder what that was all about.
But yeah, I mean, I think that's been the primary driver of markets this week, hasn't it? It's really been about the data, obviously the shutdown coming to an end and the damage the shutdown has done and what that might mean for central bank policy going forward.
Yeah, very much so. And of course, one of the things that we haven't had for the last 6 or 7 weeks is economic data, certainly out of the United States. All of the official statistics have been delayed or postponed as a result of the shutdown. So I think what participants now want to see is we've sort of moved past that initial optimism or euphoria of the government is reopened, normality is returning, etc., etc. And the question now is, well, what's actually been happening to the economy over the last 6 weeks? What has the labour market been doing? Have inflationary pressures been bubbling away, or have they started to subside? Have employers been continuing to shed jobs, etc., etc.? Those are the questions that I think participants are now looking to have answered in this sort of final 5 or 6 week stretch into the end of the year.
Indeed. So obviously that's going to be the main topic of discussion over the course of the next 5 or 6 weeks. until obviously the next decision to cut rates or not only in the US, but I also think here in the UK, because obviously concerns about the budget coming up. We've had some very weak economic data this week, not only unemployment, but wages, but also the GDP numbers this morning. We'll talk about that. We'll move on to the latest earnings from Vodafone, which prompted a fairly nice, decent share price pop. We've had Rolls-Royce this morning, which has been a bit of a meh reaction, I think, but nothing, I think, to be overly concerned about there. Numbers from Burberry, B&M European Retail. We've also had numbers from the defence sector again, Chemring and Kinetic this week, as well as Disney. Disney's fourth quarter numbers also came out this morning before we move on to next week. And obviously the latest CPI numbers for October, the latest Fed minutes, as well as some fairly big earnings announcements out of the US, namely Nvidia.
I was going to say the most important earnings release the world has ever seen, if you believe half the sell side.
Yeah, indeed. Since the last one.
Yeah, exactly. And until the next one.
Yeah. and we've also got some very important retail updates from the US as well, in the form of Home Depot, if you want to pronounce it the UK way, Home Depot, Walmart, and Target. Target, as I like to call them, as most Americans like to call them. And I know you don't believe me on that, but
I really don't. But
it is true. It's very, very true, mate. Anyway, so those are the topics for today, this week. Let's start with the US economy. So I noticed earlier this week that you and Ryan were having a little bit of a set to ADP versus BLS discuss. Now, I'm going to be slightly controversial here and say that I actually back Ryan on this, because ADP is based on empirical data from firms. So it's real data, real payrolls from real firms on a month-to-month basis, private sector firms. So I think you've got a much better gauge, because the ADP report is actually based on real data. Now, you can basically criticize it as much as you like, and you have. You have, but ultimately it's a much more scientifically grounded method than what the BLS use, whose methods are still grounded in the 20th century.
Yeah, I see. I totally take the point. I think I have two issues with the ADP number, and I would say this is, I'll keep it brief for the sake of the podcast. But I would also say that it's a slightly unfair contest, because the BLS numbers haven't actually been released since August because of the shutdown. So we are very much sort of beggars can't be choosers.
And they're always revised lower by about 1 million a year. So, I mean, how reliable can they be?
Certainly over the last couple of years.
Yeah.
The two issues I have with ADP, one is the methodology. We simply don't know what it is. The ADP, I mean, they're a private company. They're well within their rights not to share it, but we don't really know what their sampling is, whether they revise their own data, how they actually calculate the numbers. So there's a lot of unknowns around it. The second problem I have with the ADP is, fine, we can talk about data reliability and all the rest of it, but the ADP are actually producing two numbers at this point. They're producing the monthly employment change, which they have done for donkey's years. And in October, that pointed to employment in the US economy having risen by 42,000. They're also producing a weekly employment gauge, and that pointed to, in the 4 weeks to the 25th of October, a weekly decline on average of 11,000 jobs, which when you extrapolate that is 44,000 jobs that the US economy apparently lost in October. So the ADP producing two reports which tell you two completely different things about where the US labour market is going.
I suppose it really depends on the starting point and the ending point for both reports, because both can be true.
Both can be true.
If they've got different starting points. But to my mind, I mean, if that is the case, then they need to harmonise them to the same starting point.
Yes, they do need to do that. And actually, I don't know, why am I giving them the benefit of the doubt on this one? I'm killing my own argument here. But to give them the benefit of the doubt, they did only start producing this weekly data about a fortnight ago. So there may be some teething troubles on that one. But I do think the belief is that we will be getting the official September jobs report probably next Tuesday or Wednesday, given the precedent from previous shutdowns. And obviously the market going to be highly, highly sensitive to that data.
Which jobs report will that be? Because the White House have said, sorry to interrupt you, that
No.
October CPI and October jobs may not be released.
Yeah, so that'll be the September report. So the September report has been collected. It's basically sat on someone's desk waiting to just be pushed out. The October report, as you say, there's some doubt as to whether we will ever see that. But the market is obviously going to be highly sensitive to the September data, even though it is effectively 2 months old at this point. And we have actually seen quite a lot of hawkish Fed speakers this week talking about how, and voters and non-voters, incidentally, about how they may be reluctant to deliver another rate cut in December. Well, I think if the September jobs report is a bit wobbly, then all of that reluctance is going to go away very, very quickly indeed.
Yeah, but obviously that assumes you can trust the data that comes out for that particular jobs report.
Well, of course it does, but I guess we're going to have to try and trust it. And speaking of that, I mean, can you trust the UK data that we've had?
Oh yeah, I mean, we'll come on to that in a minute. Q3 GDP in the US was trending at 4%. Obviously, Q4 is going to be a completely different ballgame. I think that's inevitable.
Yeah.
We saw strong growth. We're going to see a slowdown in Q4. Do we know the type of slowdown we're going to see in Q4?
Well, I think that you're absolutely right. So you're looking at GDP in Q3 tracking at about 4%. That's what the Atlanta Fed's model suggests it's going to be. The rule of thumb has always been between a tenth and about a tenth of a percent is lopped off GDP on a quarterly growth basis for every week of a shutdown. So you're looking at a 6-week-long shutdown effectively. Very, very simply, you'd say somewhere between 6 and maybe 8/10 would be knocked off of US GDP growth as a result. The ordinarily, all of that would then just be recouped in the following quarter when the government reopens again. It's more of a sort of statistical quirk than anything else. I think what we'll really be paying very, very close attention to is there any long-lasting effect of the shutdown? Because, of course, this hasn't been a sort of week-long affair as we've seen in the past. It's been 42 days. Certainly, is that going to be a longer-run headwind to things like retail sales? Are there going to be government-adjacent sectors that rely on government contracts that struggle because of that 6 or 7 week long interruption to their business activities? I think that's the concern, is that, while it's great that the shutdown's over and we can get back to a bit of normality, what's the hangover going to be like ultimately?
I think that's the big thing, because I've written in my note this week, and I don't know whether you've read it, and it's with respect to not only obviously in the opening topic, but also the Fed minutes next week, which are going to be stale. They're not really going to be particularly instructive in the context of what the US economy looks like now.
Yeah.
But SNAP benefits basically got cut to 42 million Americans over the course of the last 6 weeks. Now, SNAP benefits are assistance programs, basically food stamps.
Yeah.
And that means that they will not be getting their monthly payments or weekly payments or whatever in full. Some may be getting partial, but that will prompt a significant retail slowdown on the part of the US consumer. Now, I don't know whether that's been reflected in the consumer confidence numbers as of yet, but you can certainly be sure that it will be reflected in the retail sales numbers, as well as obviously next week's numbers from Walmart and Target.
Yeah, I was going to say those. Any guidance that Walmart issue on that front will be very, very interesting, actually. And you say in terms of consumer sentiment, well, we did have the University of Michigan numbers out last week, and in November that fell, as near as makes no difference, to a record low. I think we were just off the lowest level that we printed during the pandemic. So, not surprising that, given the government shutdown, the termination of assistance programs, and just generally the negativity that you would have had in the news in the US over the last 6 weeks or so, it's not a surprise that consumer sentiment has slumped. But again, as you say, the key question is, has that followed through with, or been followed up with a slump in spending? And if it has, that could be a real issue.
I think it will, and ultimately it will then depend on how quickly these benefits get restarted in terms of the rebound in consumer sentiment. So I think that's something to watch for. I think we could see a very poor start to the fourth quarter as a consequence of that. The big question will be then is whether the US consumer can make up for that in the lead up to Thanksgiving and Christmas, which generally tends to be a golden quarter for retailers in general. So I think that for me will determine whether or not between now and December, whether the Fed decides to cut rates again.
Yeah, absolutely. And I think my base case, my gut feeling is still that they will. I
Mm.
think that's sort of the path of least regret, if you want to frame it that way, is to deliver another cut. Obviously, with the caveat, we've still got a month to go until that meeting. But I
Mm.
do think we're going to see much greater dissent among policymakers. We are going to have probably more than one dissenting in favour of standing pat at that meeting. But a lot can happen in a month. Conceivably, we get 3 jobs reports and 2 or 3 CPI numbers between now and then. So there are plenty of moving parts still in that equation.
Okay, well, let's move away from the States. Obviously, the shutdown is coming to an end. The Dow's hit a record high.
Mm,
S&P, S&P and Nasdaq haven't really done that much. FTSE, on the other hand, made new record highs,
indeed.
which is surprising given the data that we've seen come out of the UK this week.
Well, in many ways, I would argue that it's because of that data, because everyone's sort of gone all in on the idea of a Bank of England cut in December, and sterling has weakened a fair chunk, which has probably not harmed the FTSE at all.
And will continue to weaken.
Well, yeah, exactly. I was surprised that we didn't make a break below 130 either this week or towards the back end of last week. I thought we might, but it does feel somewhat inevitable that the path of least resistance does still point lower for the pound.
I think it's coming. I just think that we may go back to 134 first before we
Yeah.
roll over again. These things are never a straight line. But
No.
certainly in terms of the unemployment data, I mean, I can remember saying to you earlier this year, I wouldn't be surprised if we see 5% by the end of the year. We're
Hmm.
there already.
Well, indeed, and I
Unemployment, I
don't.
mean.
Yeah, and that's of course in the 3 months to September. I don't think
Yeah.
either of us are particularly pleased that prediction has come true, but there we go. The Bank of England expect unemployment to peak at 5.1%. I would say that's probably an optimistic estimate given the data that we had
Yeah.
this week. I think unemployment obviously runs up to September. If you look at some of the more timely indicators like the PAYE payroll data, employment fell 32,000 in October. That's the biggest 1 month fall since November of 2020. Of course, the big difference between now and November 2020 is we're not in the middle of a pandemic and we
Yeah.
haven't just been locked down. But frankly, none of this is surprising. We've spoken about this at length. The government has increased the cost of hiring by a higher employer national insurance contributions. They've increased the risk associated with hiring because of this new workers' rights bill. They're effectively providing a greater reward not to work with these benefits uplifts that we're seeing. And it's almost certain in just under 2 weeks' time that there's going to be even less of an incentive to work because income tax is going to be going up by a couple of pence in the pound. So, frankly, this is a mess of their own making, even if the Chancellor is running around blaming everyone but herself.
Yeah, I mean, I don't think anyone disputes that Labour didn't get a particularly good legacy from the previous
Mm.
government. But all they've done is just made things even worse.
Yeah, absolutely.
I think it's it plays well to their base to blame the evil Tories and what have you. But most right thinking, logical thinking people will see that's the nonsense for what it is, and it is nonsense.
Yeah.
You
It
know,
is complete nonsense. And actually, I think this is what rankles so much is that it would be so much better for the Chancellor or anyone in the government to stand up and say, look, this is our fault. These are the policies we've put in place. We will own up to this. I think, if this was a year ago and you're 5 months into an administration, then yeah, you reasonably can lay some of the blame at the door of the people who came before you. We're 15 months in now. The honeymoon period is over. This is a direct result of the policies that they have implemented and are looking to implement in the coming months. And, we'll move on to the GDP data in a moment, but even that isn't their fault, apparently.
well, it is. Well, no, you know why? You know who they're blaming for that, don't you? It's the Jaguar Land Rover shutdown.
Yeah.
But by that same token, now that production's restarted, we should see a massive rebound in GDP growth in Q4, which we all know is unlikely to happen.
Well,
But even if, let's say, for example, let's look at the unemployment rate, for example. Okay, it's gone from 4.4%, which is what it was in July 2024 when they basically took the reins. It's now 5%. In no other country in the G7 has the unemployment rate gone up to the same extent.
yep.
No other country.
Yeah.
Our energy costs, our inflation rate is 3 or 4 times higher than that in France.
Yeah.
And you can't say that France is a particularly, accelerating away at speed when it comes to GDP growth. Their economy is also growing better. Why is that? Because ultimately they haven't imposed 70 billion or however many billion pounds in tax rises, and they don't have sky high energy costs.
Mm-hmm. Exactly that. It's not rocket science. I know we say that a lot, but it really is not rocket science. And you think on an incentive basis, going back to what we were talking about earlier, where's the incentive for firms to hire workers at this moment in time? And actually, from a worker perspective, a lot of people will be going, where's the incentive for me to work? Because the government will, effectively pay me to sit at home. And just, moving on to the GDP numbers, yes, the economy grew by 0.1% quarter on quarter in Q3, with the economy actually contracting by a tenth on a month-on-month basis in September. And yeah, they're going to blame that on the Jaguar Land Rover shutdown. And yes, that is true. And yes, production fell off a cliff. We all know that. But frankly, even if you take the impact of that out, the economy would have just grown by a tenth of 1% in September. We're arguing about an economy that is, for all intents and purposes, a rounding error away from just completely flatlining. And I zoomed out on the data this morning. In 4 of the last 5 quarters, the economy has grown by less than 0.3%. And in the one quarter when we actually exceeded that pace, it was because the data was horrifically skewed by all the tariff front running that was going on earlier in the year. The long and the short of the matter is that the economy just has not done anything for getting on for a year and a half now.
Yeah. So plague on all their houses, basically.
Well, indeed. And I think, the labour market data certainly just firms up the idea that unless we get a huge surprise in either the October or the November CPI data, I think the BOE are nailed on to deliver a 25 basis point cut next month now.
Yeah, but I don't think it will be a majority vote.
No, I don't think it will either. I mean, I think, you've got 4 in that dovish camp already. Governor Bailey will join them to make 5 to make it a majority. Yeah. Are any of the others going to join him? I guess that depends on how inflation evolves between now and then. But I agree, there will definitely be at least a few hawkish dissents at that meeting.
I mean, I asked the question in my weekly Substack. What will it take to shift Bailey from a hold to a cut? An inflation rate of, it's been 3.8% for the past 3 months. So will it be a slowdown to 3.7, 3.6, 3.5? What if it stays at 3.8?
Well, I think if it stays at 3.8, then the bank have a problem, because you can't then reasonably make the argument that inflation has peaked and is on the downward path, which is the argument that they would want to make. You would imagine that they want to sit there at that December meeting and say inflation's peaked. We've had 2 months at 3.8, August and September. We've had another 2 months of data showing continued disinflation. We are comfortable with that trajectory now being embedded. We are happy to deliver another rate reduction. If that isn't the case, I think it's a much, much more difficult argument to actually deliver that rate cut in December, because you're effectively then saying, yeah, fine, the inflation problem hasn't got any worse, but if we've been plateauing at 3.8% for 4 months, then I would say that's a persistent price pressure that you need to stamp out by remaining in a more restrictive policy setting.
And let's not forget, a weaker pound makes it much harder for that inflation level to come down.
Indeed, yeah, and if we break below 130, then that's a big problem.
It is. The problem is it's a self-fulfilling prophecy. If the market thinks they're going to cut rates,
yes,
they'll sell
indeed.
the pound.
Yeah, and well, not that they need much of an excuse, because the budget's giving them every excuse they need at this point anyway.
Yeah, indeed. So I think much will depend on the budget, which obviously is in a couple of weeks' time. And so we've got 2 CPI reports. We've got a budget, and obviously we've got more unemployment reports as well. So the Bank of England's got a bit of a dilemma when it comes to, we might get one more rate cut, but how many more can we expect to see?
I think that's a question for 2026, isn't it? Do they then lean in and really try and support the labour market or support economic growth, or do they worry about the risks of persistent inflation? And I think, again, that's where you're going to see a big split on the MPC.
Well, they don't have a growth mandate, the Bank of England. They don't have a dual mandate like the Federal Reserve. They have an inflation target, and that is their job. irrespective
Yes.
of what the government may or may not say or do. And we had that speech earlier this month. Rachel Reeves was, I think, exerting some political pressure
Mm.
on the Bank of England to cut rates. But, for me, it's it's not the Bank of England's job to bail out the government.
No, absolutely not. It's the Bank of England's job to act as that independent anchor to ensure that prices remain stable at 2%, not to just bail out the government of the day.
And I've heard a lot of things on social media saying that the Bank of England is not accountable. It shouldn't be independent. But let me pose this question. Do we really want to go back to the days when politicians on the eve of an election decided to cut interest rates because it suited their own political narrative? What we've got at the moment is not perfect, but for me, it's preferable to the alternative of political interference, which, okay, there is some element of that because we're seeing that in the States,
Mm.
but at least there is a separation there.
Yeah, exactly that. And I fully agree with you. This is like that famous Churchill thing about democracy being the worst form of government except all the others. Monetary policy independence is the worst form of operation apart from all the others. I would much rather have ostensibly independent individuals, and you can question that, and that's a debate for another time. But I would much rather that we have experts who are operating at arm's length from the politicians, setting policy based on economic conditions at the time, as opposed to trying to juice up opinion polls in the run up to an election.
And acting as an anchor on some of the worst, what I would call the worst, sort of inclinations of politicians when it comes to fiddling around with fiscal and monetary policy. I mean, obviously politicians do fiscal policy, bankers do, central bankers do monetary policy. Yeah, there's a lot for central bankers to answer for over the course of the last 20 years. But does anyone really think that governments would have done better?
Well, exactly. I mean, the truth of the matter is we will never know the definitive answer to that, but I would be very, very surprised if they did.
It's an imperfect solution in an imperfect world. But is it the best imperfect solution or the worst one?
I would say it's the best, and I would staunchly defend that. But there we go.
Anyway, let's do earnings. Let's do earnings. Vodafone, fairly decent reaction, share price reaction to their first half numbers. I had a good look at them. Finally returned to growth in Germany. Popped up to 96p, the share price. Service revenue.
2-year highs, isn't it?
2-year highs. Yeah, absolutely. And the company said it expects to increase this year's dividend by 2.5%. I mean, the shares still remain well below where they were, years and years ago. And they're unlikely to return to those sorts of levels. But I think the mere fact that they've posted the highest levels since 2023 is maybe evidence that they've finally turned the corner.
Yeah, I think that's the message. I think not only from the share price reaction, but from the results as well. It feels like they might finally be sustainably turning things around. And I think that return to growth in Germany is something that the market is really cheering as a sign that actually maybe the worst is now behind us. And it's a case of onwards and upwards from here on in.
Yeah, I mean, operating profits were down 9.2% to 2.2 billion euros. But a large part of that was down to restructuring costs because of the merger with Three. Hopefully that will be behind them now and they can start moving forward, growing service revenue in Germany and growing it in the UK, the two largest markets.
Yeah. And of course, the dividend increase, if I could even say it, won't have done any harm either.
No, it's always useful to have a dividend increase, and with the share price going higher, that's in the right direction as well, because you don't want a falling share price.
No, absolutely not.
So that looks promising. Yeah, we're off the highs, but we gapped higher from 88p to 96p. We're around about 94p now. So the next target, I think, for me is 100p. But momentum...
Yeah, it's just a round figure, isn't it, now?
Momentum is now starting to turn positive. And barring any mishaps, I think there's potential for further gains in the Vodafone share price. Certainly looks that way anyway.
Yeah, indeed.
Okay. Rolls-Royce.
Yes.
Nothing really much to cheer, but also nothing to be overly concerned about.
Yeah, I think that's a good framing. It almost just as you were, I guess, is very much the energy, which I suppose explains why the market has just sort of looked at all of this and shrugged their shoulders. Certainly no bad news, but also nothing in the report that you would go, this is incredible. But, it is. The stock has done so well, not just this year, but over the last 3 or 4 years now, that really there's nothing to dislike about what they're doing, is there?
No, I mean I was looking at the guidance that's been left unchanged. Full year underlying profit between 3.1 and 3.2 billion pounds. Free cash flow round about the same sort of level. The civil aviation division's doing well with decent levels of engine orders. The defence side, they've just signed a new contract with the Turkey
for these
Eurofighters with EJ200 engines, and the SMR business. They're moving forward with GB Energy with respect to commercial terms on the SMR reactors. And obviously there was that report this morning that the US government's a little bit annoyed by the fact that SMR basically won out over Westinghouse.
Yeah, but I mean,
what do you expect? If you're going to prioritise US business over overseas business, don't be surprised if everyone else does the same.
Well, this is it. If the shoe was on the other foot, we all know how that would go.
Yeah,
so,
exactly.
Ultimately, I think they're making a bit of a mountain out of a molehill on that one.
Get over it.
Yeah, exactly. It's understandable why they'd react like that, but at the same time, get a grip.
I mean, basically, if you're prioritising your own domestic companies over overseas companies, don't be surprised if other countries do the same thing.
Yeah, and actually, why wouldn't you?
Well, yeah, exactly. It's just a bloody nonsense. Sorry. Anyway.
Moving on.
Burberry.
Yes.
Burberry. That it's tried to take out the July peaks. Again, well received. For me, the numbers are okay, but there's certainly nothing to write home about. We did see an improvement in operating margins, but the company still posted a loss. Okay, a smaller loss than the previous year.
Yeah.
And there was a recovery in the China and APAC regions, which obviously is, offset the sharp declines that we saw in the first quarter. So it does appear to be on target, but it would have hard to have been worse.
Well, I think this is it. The bar was so low that actually, if it was worse, then that would be highly concerning indeed. I think that from a macro perspective, the signs of recovery in China is an interesting comment because, of course, for the luxury sector as a whole, China is a pivotal market. And if we are starting to see a bit of a turnaround there and demand starting to pick back up, then that could be a sort of tailwind for the sector at large. I think the other thing that I sort of pulled out of the report is like-for-like sales, which actually rose by a couple of percent. Which, again, it's not a huge amount, but it's again a sign that perhaps things are starting to more durably move in the right direction. But again, in terms of market expectations, they've been beaten up so significantly and everyone's so pessimistic that, the bar is effectively on the floor for them to clamber over. And, they just about managed to get over it, I think.
Yeah, I think for me, the share price needs to move above the highs this year. Momentum... At the moment, it's been trading in a range. The bottom end of that range is around about £10.60, £10.50. Top end of the range is around about £13.60. So it's been trading in that corridor of around about 300p, £3.
Yeah.
And if we can break out of that range, then we could well see, hopefully, a shift to the upside.
Indeed.
B&M European Retail.
I was going to say, moving right to the other end of the retail spectrum with this one.
Yeah, I mean, both the share prices are up 1% today. I mean, B&M's have been battered so much that it's hard to imagine that they could be bashed much lower. Famous last words. But
that's technically known as putting the kibosh on them, I think.
Yeah, it is. But they did announce an interim dividend of 3.5p. That was down from last year's 5.3. Understandable given the fact that obviously profits are down, EBITDA is lower, but they didn't change their group adjusted EBITDA for the first half. They've kept their full year guidance unchanged for EBITDA. So hopefully the worst is over and they won't drop below 150p.
Yeah, you'd certainly hope so. And I think one of the things they did do was get the bad news out the way early, because
Mm.
they issued this. Well, it came as a surprise at the time, but the profit warning
Mm.
and all of this guidance. Well, it must have been about a month or so ago now. So actually, the
Beginning of
fact that
October, yeah.
yeah. Oh God, doesn't time fly?
Mm.
It feels like a lot longer ago than that. But yeah, because there weren't any further negative surprises, actually the market had already priced in and discounted that information, and there wasn't much to react to today. The other thing is they're conducting a bit of a leadership reshuffle as well. So perhaps that is going to be another catalyst for them to turn around as well. But yeah, I think I'd be with you. I'd be maybe cautiously optimistic that the worst is in the rearview mirror, but we'll need a few months more trading updates to be confident of that. I think.
I think with B&M, it's one of those retailers that should do well if the economy is not.
Yes, they're counter-cyclical, aren't they?
Yeah. So, given the numbers that we've seen today and the numbers we're likely to see in Q4, you'd like to think that going forward over the next 6 to 12 months, that more people will shop there, because
Yeah.
ultimately it is a budget retailer.
Yeah, exactly that. And what we mean by that, counter-cyclical, to distill that into language that people actually use down the pub, basically means that if the economy is rolling over, if people are losing their jobs, have less disposable income, looking to tighten their belts, they're naturally going to be pivoting towards that more sort of lower cost budget end of the market, which is, of course, where we know B&M operated.
Yeah, indeed. And they are still opening stores. So I think they still have a fairly positive overview of their overall outlook when it comes to revenue, even though
Yes.
revenues revenues were up by 4%. So
And
that's
actually, although
going in the right direction.
it sounds odd to say they're expanding stores into what could be a bit of an economic downturn, but it makes sense, because if the business is going to do well in a period like that, then that's exactly what they should be doing.
Right. We're going to look at the defence sector. Chemring and Kinetic, both very FTSE 250 stocks, posted some updates this week. Chemring on Monday, Kinetic today. Bit of a meh reaction to the Chemring one. Not really too much to say on that. It expects full year adjusted operating profit to be in line with expectations. So
Yeah,
that's Chemring,
which is fine.
which is pretty unremarkable. New contracts, that's positive. UK Q3 trading in the UK has been at the lower end of expectations, and I think that's basically, perhaps why they've struggled to make any real gains this week. The share price is down this week. Kinetic, on the other hand, seen a fairly decent rebound today. Initial disappointment over a 10% decline in operating profit as well as revenue, but their order book, huge jump in the order book.
Yeah, I mean, $1.5 billion, isn't it? Up to 4.4 billion now, effectively.
It's gone 2.9 to 4.35.
Yeah, I think, again, and it sounds almost odd to say this, but I think we spoke about this before when, there was this big surge in defence spending earlier in the year. It's great that these order books are so full and so big and they're bursting at the seams. The question is, are these firms, this is not just Kinetic, but all of the defence companies, are they actually going to be able to fulfill all of these orders in a reasonable space of time, in a similar way to what we're seeing in the whole sort of AI space, where the demand for chips and GPUs and semiconductors is so huge that, everyone wants them, but the company simply can't fulfill the orders. Is that going to be the constraint on growth moving forwards? The fact that they just simply cannot work and produce at any faster rate than they're already doing?
Yeah, it's about capacity utilization, isn't it?
Yeah, which I would imagine is pretty close to 100% as it is.
Yeah. Okay, let's finish off this week. We had Disney's fourth quarter numbers this morning, and the markets do not like them.
No, they don't. And I was hoping you'd give me a second, because I haven't got a chart in front of me there.
No, that's fine. They're down 8.5%. They're down 8.5%.
Rather.
Sorry. Yeah, I mean, Disney share price down 8.6%. As I'm talking to you right now, even though they weren't that bad. Bit of a mixed bag. They beat on profits, but revenues came up short.
Indeed, but I think this is, sorry to interrupt, I think this is almost a bit of a trend that we've seen throughout earnings season, where any softness, no matter how marginal or how small that softness may be, is punished really, really severely by a market that ultimately is kind of priced to perfection. Any subpar earnings or guidance is just, going down like a complete and utter lead balloon, no matter what sector you're operating in.
Yeah, I mean, I'm looking at the daily price chart here, and the shares were trading at the highest levels in 2 months, and now they're trading at 5 month lows.
Yeah, I was going to say we're back to the
in the
sort of
space of
May
a
where we
day.
were in early
Yeah,
May. Yeah,
in May.
exactly.
And
And also that's despite the fact that they've boosted the dividend and doubled their share buybacks, which you would imagine to some extent are going to be cushioning that downside a little bit as well.
Yeah. I mean, I looked across all the businesses, right? Streaming's doing well. It's profitable. Obviously, the Hulu integration is continuing apace, so that Disney Plus and Hulu are now becoming completely integrated on both sides of the Atlantic.
Yep.
Parks and entertainment also did very well. Parks and experiences, rather. Revenues there increased by 6%. But it's TV and film where they're falling short. Revenues there were down 6% on cinema releases and TV and films. And to be quite honest, when I look at the film
Here we go.
slate, when I
Put
look
your
at
feet up, ladies and gentlemen. A rant is incoming.
when you look at the films that they've pushed out there, why would you go and see reboots of Lilo and Stitch, Fantastic Four, Thunderbolts? They're all recycled ideas. They're all old ideas. Marvel has been done to death. Marvel was great, 2008 to 2019. Avengers Endgame and all of that sort of stuff. And now they're just basically beating people into submission with these reboots and these rehashes. And to be quite honest, they're all crap.
Yeah, I agree. It just feels like they're out of ideas, to be completely honest with you.
Exactly
It's almost like terrestrial television channels that are just running repeats of old programs all day long. Disney are basically doing the same thing. And I think if we are to see a considerable pickup in revenue on that side of the business, ultimately, you've got to improve your creativity. You've got to bring something new to the party, and they're not doing that at the moment.
Give us something we want to go and see.
Yeah.
And stop beating us over the head with political messaging.
Yeah, exactly that.
Anyway, rant over. As we move on to the week ahead. We talked about CPI. I don't think we really need to rehash those arguments. Do we have an expectation of what October CPI is going to be, or are the assessments not out yet? My concern is that it remains sticky at 3.8%.
I think that's the worry. We don't have a consensus figure just yet, but the Bank of England in the November monetary policy report, which was obviously out last week, they expect headline CPI at 3.6% in October, and then they expect that to drop further to 3.4% in November. So that's the benchmark we're operating against. Basically, I think it's pretty binary at this point. If CPI comes in line with those two numbers that I just gave you over the next couple of months, they'll be comfortable to deliver another cut. If we're unchanged at 3.8 or marginally hotter than their forecasts, then they might be in two minds. But as you said, we've discussed that already, and money markets basically pricing it as a certainty after the jobs data anyway.
Okay. Fed minutes, again, it's going to be difficult to really, I think, derive too much idea as to what the Fed might do in December, because we already know there's a three-way split. And that meeting came against a fundamentally different macroeconomic backdrop to the one that we're facing now.
Yes, absolutely. And again, they are very stale. I don't think they're going to tell us much that we don't know already. The key determinant of what the Fed do next and how those divisions on the committee shake out over the next 4 weeks is going to be incoming economic data. How has the economy evolved in effectively a 6 or 7 week long vacuum where we haven't had any figures? What's the economy actually been doing? Because, it's all well and good. We've had various Fed speakers coming out this week saying, they don't see much by way of downside risk to the labour market. They're worried about inflation. They think the labour market's bottoming out, etc. Well, if we get a negative non-farm payrolls number in September, there'll be a lot of humble pie being eaten in the States, I think.
Which is probably why they're not going to publish an October one.
Well, actually, funny you mentioned that. Kevin Hassett, the White House economic advisor, has been talking away while we've been recording, and he said that his belief, so take that with a bucket of salt, is that we will get the establishment survey, so non-farm payrolls and earnings data, but we won't get the household survey, which is things like unemployment and participation. But it's Kevin Hassett, so I'm not entirely sure that we can believe that one.
Okay, UK retail sales for October. In July, August and September, we saw some really good readings, 0.6, 0.5, 0.6 and 0.5 respectively. So there's your GDP expansion in Q3, right there.
Yes.
Right there. So this time last year, we saw retail sales in October, November and December all come in negative.
Yeah. Is history going to repeat itself?
Yeah, is history going to repeat itself? I have a feeling it might, because ultimately the backdrop feels the same in terms of the media narrative, uncertainty, the budget. Basically, it seems like this government is repeating all of the mistakes it made last year again. So expecting a completely different outcome.
Yeah, I think you're right. And I think actually I would argue that there's probably a bigger risk of a significant slump in sales and in consumption this year, primarily because the mistake that they made last year was a huge tax hiking budget. The burden of those tax rises largely fell on employers, which meant that, yes, there was some follow-through impact, but that had a big hit to consumption. This time, the burden of those tax hikes is falling squarely on you, me, our listeners, and every working person in this country whose basic rate of income tax is about to go up by 2p, which means that everyone is going to be having less money to spend. Everyone is going to be looking to tighten their belts. It's not going to be the, relatively speaking, limited hit to consumption we had last year. It's going to be a very, very broad-based one across the entire economy. So I would say, as much as anything is a certainty in economics, I think it's going to be a very tough autumn and winter for UK PLC.
You're assuming that, of course, they don't cut the national insurance rate by that same amount.
Yes, but even if they do, I think anyone earning over about 45, 50 grand is still going to end up worse off.
Yeah, which, but they're not working people, right?
Don't bait me into that, Mr. Hewson. Don't you dare.
Anyone earning over 46,000 isn't a working person, according to this definition of the government, apparently.
No, this isn't work, actually, guys. We just do this for fun.
They're just people to be bled dry even further.
God,
before they just basically pack up and go somewhere else and do it. Anyway,
yeah, quite.
Moving on. Earnings next week. We've got Babcock's first half numbers, defence sector again. When they published their first half their full year numbers back in June, full year revenues were 4.8 billion, up 11%, with a possibility of more to come. So I think in terms of Babcock's, there's going to be an awful lot of high expectations of further decent performance. They've done well so far this year to date, but they've sort of traded sideways pretty much since September. So currently £12, looking for another push higher on the back of, obviously, a big or an increase in the contract order book, which currently is about £10.4 billion as it is.
Yeah, it's going to be interesting to see how much further that rises, particularly given what we were just talking about with Kinetic earlier on.
Yeah, because I think there is an expectation that they want to be able to deliver on an operating margin of 8% or more in 2026. Currently below that, so we'll have to wait and see how that plays out. But certainly, I think I'll be disappointed if there isn't an earnings upgrade there.
Yeah,
JD Sports, another retailer. Again, their share price hasn't really done too much since the summer, traded sideways. Obviously, having to integrate Hibbett, the US business, into its store portfolio means that it's incurred an awful lot of cost, but it's still on course to make a fairly decent profit. Despite the recent downgrades. I mean, I think before it started on its downgrade path, profits were about $1 billion. Now they're around about 840 million. I mean, that's still a decent chunk of change.
Yeah, exactly, and that's not the biggest hit in the world, considering the integration that they've had to do. And actually, as you've written in your note here, one of the other things is that it seems like all the concerns over tariffs and how that would impact the business might have been rather over the top. So again, is there a potential source of upside from that, given that actually the outcome now, certainly in terms of US-China relations, is arguably at the most benign that it's been for most of the year?
Yeah, Imperial Brands, full-year numbers. Obviously, there's NGP. That's been, I think, the cornerstone of most investors' expectations. They're non-tobacco products. Are they continuing to improve their market share there? Shares are at their highest levels this week, hit their highest levels this week. I think they may have hit record highs this week. No, not quite. We're not quite there yet, but we're back at levels last seen in 2017. So those continue to go from strength to strength, fairly decent dividend. It's one of those that I would describe as a pretty boring defensive stock, but nonetheless has a tendency to deliver, even if it's boring and strong and steady. Is that the word?
Yeah.
Strong and steady?
Slow and steady.
Slow and steady, that's it. Slow and steady wins the race.
Tell you what's not slow and steady. And don't get a chip on your shoulder about that pun.
Oh, my God. Please help me. Okay, Nvidia, Michael, what are we expecting next week?
Well, what we are expecting, I'll let you do the figures in a moment, but just the headline, I saw that I've stolen this from Bloomberg, so rather shameless of me. But options on Nvidia's stock imply a move of about 6% after hours next Wednesday when they report earnings. Well, Either way.
Okay.
If you equate that to its market cap, it's about $300 billion, which, if realised, is looking at potentially the biggest ever swing in market cap in a stock after its earnings release, which will be absolutely humongous because, of course, Nvidia are around that $5 trillion market cap now, aren't they?
Well, 4.7, I think.
Yeah, they've pulled back a little bit. Yeah. They've come back under that $200 mark. But, the question that I would ask, and I think we ask this quite often when NVIDIA report, is it just too high a bar in terms of expectations that they're going to find it almost impossible to meet the market's expectations for them?
Well, at some point, probably. The big question is when. I mean, we've talked at length about Next and its ability to, consistently upgrade its guidance, and it's consistently done that for the last 2 years. Will Nvidia continue to push higher, irrespective of the numbers that it puts out? I mean, the bar is fairly high, I think.
Incredibly so, yeah.
I mean, Q2 revenue was $46.7 billion, and that was well ahead of forecasts. Well ahead. Yeah. Their expectation for Q3 is for $54 billion, plus or minus 2%.
Yeah.
I mean, that's $8 billion above Q2.
Yeah. And of course, the other thing is that all of this assumes zero sales to China, which, while that remains the case, as we just mentioned, there does seem to have been a cooling in tensions between the US and China. And if they can actually unlock some sales to China, not of Blackwell, obviously, but of some of the older generation chips, then you're looking at potentially massive upside compared to the guidance that the firm has given out previously.
And here's the thing, Michael, they still expect to increase their margins.
Yeah, exactly that. They're doing all of this at a 70-odd% margin. It's incredible.
I know. Data center business, once again, obviously is the standout performer. Of those $46.7 billion in Q2, the data center contributed $41.1 billion of that total. So, we've talked about this at length, AI infrastructure spend. All loads of companies spending billions and billions of dollars, and the share price continues to go higher. Yet when you get Rightmove here in the UK announce they're going to spend billions of pounds, the share price falls off a cliff.
Yeah, that
made me laugh.
It wouldn't make you laugh if you held Rightmove, but it made me chuckle as well.
Yeah.
I think that's quite a good summation of the conservative British attitude towards hyperscaling versus the US attitude, which is the more dollars you throw at something, the better it is. Just lastly on Nvidia, before we move on to some of the retailers, it is also, of course, worth noting that they are going to have an impact on the market at large, not only in terms of the actual index weighting, which is well over 10% in the NASDAQ. I think we're getting up towards 10% in the S&P as well. But just from a broader sentiment perspective, they are the barometer, the darling, the standout AI play. And the entire theme is basically going to, the next month or so of that theme is going to trade on the back of what Nvidia has to say on Wednesday night.
Yeah. Do you remember when they rebalanced the NASDAQ so that it wasn't so tech-heavy dominant?
Yeah, I think they're going to have to do it again soon.
Yeah, I do too.
Well, I'm pretty sure, and I'm sure someone can correct me if I'm wrong, but I'm pretty sure that when they did that, they put in place a rule that no one stock can have more than 15% of the index, 15%. Right. Nvidia are at 13.8% right now.
Okay, so we're getting close to it.
Very close.
Okay, I'm going to lump all these together because we've done 55 minutes and I want to keep it under the hour. Home Depot, Walmart, and Target. Q3 for all three: 18th, 19th, and 20th. Home Depot on the 18th, Target on the 19th, Walmart on the 20th. I think the big question here is how much has the government shutdown impacted the revenue numbers for all these big three retailers? Because ultimately, I think what these three will tell us is how well the US economy has or has not been doing over the course of the past few weeks. That should give us better clues than any official numbers.
Yeah, I completely agree with you. And of course, these are Q3 numbers, so there will be, some shutdown impact in there. I think really the focus is on the guidance, particularly Walmart. What do they have to say about the impact of those SNAP benefits being cut and how is that going to impact their earnings going forwards? But on a more optimistic note, we're moving into holiday season. So what do they have to say about that as well?
Yeah, I think that's a very key point. It's the reduction in SNAP benefits that could have caused a significant pullback, particularly in items that I would argue are discretionary, like DIY.
Yeah.
So Home Depot, keep an eye on that. Target is more of a budget retailer. Maybe they've seen a bit of an uplift as a consequence of people maybe turning towards cheaper alternatives. The downside to that is obviously Target has a very much smaller retail grocery base than Walmart.
Yes, exactly that. But it is going to be very, very interesting to see what those retailers have to say when they report, because, as you say, we've literally had no other data on the state of the US consumer recently. So we are fully reliant on them to tell us what's going on.
And Walmart did raise its guidance as a Q2 number, so it'll be interesting to see whether or not they reduce it.
Yeah, absolutely.
Okay, so that's it for this week, ladies and gentlemen. Once again, thank you very much for your company, and we'll revisit all these topics same time, same place next week. In the meantime, have a great weekend and see you next week.
Bye for now.